You ever look at one of those technical stock reports and just your eyes glaze over? It feels like it's written in a totally different language. Well, today we're going to fix that. We're going to take a real-world technical analysis for a huge company, Pfizer, and we're going to break it down piece by piece so you can see exactly what the analysts are looking at. Okay, so every analysis has to start somewhere, right? And for us, that's with a single number. On this particular day, Pfizer, ticker symbol PFE, closed at $25.51 a share. Just think of that as our "you are here" marker on the big map of the market. And that, of course, is the million-dollar question. I mean, it's the only question that really matters. Is it going up? Is it going down? Sideways? That's what this entire technical report is trying to figure out. You know what? I'm not going to make you wait till the end for the answer. Here it is. The report's final general technical score is -52%, which basically translates to a neutral rating. Kind of surprising, right? It's not a screaming buy, and it's not a get out now sell. It's right in the middle. But this is where it gets really interesting. That neutral rating doesn't tell the whole story. It comes with this little detail with upside bias. So, what does that even mean? What clues did the analyst find that led them to such a specific, kind of wishy-washy conclusion? Let's go find out. First things first, we have to figure out the stock's general direction of travel. Is it climbing a mountain, rolling down a hill, or just stuck on a flat road? That's all trend analysis is. And a key tool for spotting that trend is something called moving averages. See, instead of getting lost in all the chaotic daily jumps and dips, a moving average just smooths all of that out into one clean line. It shows you the real underlying direction over a certain amount of time, whether that's just a few days or almost a whole year. Now, here's what's so important about this slide. Look at Pfizer's current price. It's sitting above all of its key moving averages. The short-term ones, the long-term ones, it doesn't matter. The price is higher. And in the world of technical analysis, that is a classic textbook bullish sign. It's a big green flag. So, our first piece of the puzzle is in place. The price is outperforming its own history, and other little indicators in the report are pointing up. The verdict for the trend is mildly bullish. Okay, so clue number one is definitely pointing towards a more optimistic outlook. But, knowing the direction isn't quite enough. We also need to know the force behind it. Is this trend being pushed by a powerful gust of wind, or is it just a gentle breeze? That brings us to our second piece of evidence, momentum. Momentum indicators are basically the speedometer for a stock's price. They tell analysts how fast things are changing. So if momentum is high and it's picking up speed, that suggests the current trend is really strong and has legs. But if that momentum is fading, the trend might be running out of gas. And this is the slide that really explains why the final rating was neutral. The momentum picture is, well, it's a mess. It's totally mixed. On the one hand, you've got these positive signs, the green lights. But on the other, you've got this whole group of indicators flashing yellow and red, basically screaming that the stock is overbought. The report itself really says it best. Yeah, the upward energy is there, momentum is positive, but these overbought signals are like a warning flare. They suggest the stock might have climbed too high too fast and could be due for a little rest or even a small drop. This fight between the good and the bad is why the overall stance is so cautious. Okay, so we've got a slightly bullish trend, but it's fighting against some mixed momentum signals. So the next logical question is, how bumpy is this rag going to be? And that leads us to our third section, volatility and risk. So one of the most popular tools for checking out volatility is called Bollinger Bands. The easiest way to think of them is like lane markers on a highway. Most of the time, the stock price just kind of drives along, nice and easy, between those two outer bands. But whoa, look at this. The upper band, the very edge of our highway lane, is at $25.17. Pfizer's price right now? $25.51. It has actually broken out of its lane. In analyst speak, that's called a breakout, and it's a pretty big deal. It suggests there's some really strong upward pressure, but it can also mean the stock is overstretched, like a rubber band that could snap back. Now, when the report looks at the overall risk, it actually sees a pretty balanced picture. The risk you take versus the reward you might get is fairly even, and its beta, which is just a fancy way of saying how much it zigzags compared to the rest of the market, is less than 1. That means Pfizer is actually a little less volatile than the market as a whole right now. So even with that breakout, the report doesn't see it as a super risky play. All right, we've looked at the trend, we've measured the momentum, we've checked the volatility. It's time to put all of these puzzle pieces together and see what the final picture looks like. And here is the game plan. The report boils it all down to two key price levels. Think of them like lines in the sand. If Pfizer's stock can push past that $25.20 resistance level, then the path of least resistance is probably up. But if it stumbles and falls below that $24.13 support level, it's very likely going to pull back. So what's the actual recommendation here, the bottom line? Well, because of all that conflicting evidence, the official rating is neutral. The suggested move isn't to rush out and buy or to sell in a panic. It's to just hold on if you already own it, or maybe think about buying if the price dips down to that key support level we just talked about. And crucially, the report says to use a safety net, a stop loss, and to, of course, keep an eye on the actual real-world news. And that really brings us to the most important point. Technical analysis is an incredible tool. It helps us figure out probabilities based on what happened in the past, but it is not a crystal ball. Everything we've just talked about, all this careful analysis, could be thrown right out the window by one big headline. So the real question is, what kind of future event do you think could come along and completely rewrite this script?